Welcome, everyone. Thank you for joining us today for our WealthE Wednesday lunchtime session. Today, we will be discussing our Wealth Migrate marketplace, as well as two of the deals that we currently have on our marketplace, one of which will be, or actually has already been, reduced minimum investment for today's WealthE Wednesday community. Let's see, we still have a few people joining us, but I think we should get started. So I would like to just firstly introduce myself and our revenue team. My name is Gabriela Farias. I am the head of global revenue here at Wealth Migrate. Joining me today is my colleague Fritz Greuth, who is a wealth consultant and a familiar face for some of our investors here, I believe. Fritz works directly with our investors, all of you in our community, to answer your questions related to any of the deals that we have on our marketplace. I'm very thrilled to have him here with me. Welcome, Fritz.
Good afternoon, ladies and gentlemen. Thanks for that introduction, Gabby. As Gabby said, I'm a wealth consultant here at Wealth Migrate. So if you're starting this journey with us, then you might be working with me in a very short period of time. But as a wealth consultant, basically, I always just like to start the relationship off by sort of managing expectations and giving people some insights as to what they can expect from a wealth consultant. Effectively, we all know what an account manager is and sort of the responsibility that rests on the individual with a company. And we call it wealth consultants here at Wealth Migrate. That's effectively what we do. We build relationships with our clients. We really enjoy getting to know each and every one of you, your needs, and as it pertains to what we offer here. And it's great to be online. I'm happy to see all of you online today. I know it's short weeks. This time of the year, we're already in Q2, but yes, it's great to be online today.
Wonderful. And just to acknowledge the other members, obviously we are quite a large company, but the members that you probably are going to be most familiar with, obviously our CEO, Scott Pickin, founder of Wealth Migrate, the individual with the vision behind this wonderful platform, and then our other colleague, Alex Westhazen, wealth consultant with Fritz for the Wealth Migrate marketplace. Shall we get started, Fritz?
Yes, so let's get started. As always, a meaningful way to get started is what is the problem? As an investor, you want to protect yourself against market volatility by having a portfolio with a range of asset classes, such as stocks and bonds. You're looking at real estate with fewer fluctuations than the stock market and higher historic long-term gains. Real estate should arguably be a core component of a diversified portfolio. Yet we do find that as investors trying to get access to real estate, that really from a retail perspective, and in this case, retail means the everyday investor, such as most of us here today, and for sure, including myself. We don't have generally the access that we would like to the wealth creation that real estate ultimately creates. And really, as an investor in real estate, you're generally confined to your own country. And in some cases just in your own area. And if you look at South Africa, for instance, it's much easier to get into residential, for instance, than it is to get into commercial real estate, where that consistent long-term returns and wealth creation actually happens in a very tangible way. There are high barriers to getting in. There's a lot of admin involved to get involved in real estate. We all know this, everyone that has been involved with real estate investment in the past, and not even to mention the complexities around actually going offshore and exposing you to offshore real estate opportunities. I mean, where do you begin? Who do you partner with? Who do you trust? I mean, Scott himself knows, and he mentions this many times in his webinars, that, when he started IPS, which was the company before Wealth Migrate, helping investors invest offshore, those were one of the major learning curves. You can't expect from a South African perspective, for instance, to go and invest in the US by yourself, buy a property, and operate that as effectively as you would in your own country. So effectively, this access is what we're talking about here today, and how to get access to these high quality institutional level quality deals with sponsors, the suppliers of the opportunities who really carry that credibility, that historic track record, and those expertise to be able to pull off the value creation consistently that we seek from real estate. Now, you know what we offer. You can basically invest offshore without any of the hassles or costs that has accompanied offshore investing until now. As I said, there's no need for you to figure out and pay for complex legal structures. For those of you who do not know what structures are, you know, it's basically the mechanisms used to be able to, in a tax efficient and compliant way, facilitate one's investment into an opportunity, whether that be local or whether that be offshore. Of course, when you go offshore, it becomes way more complicated from every aspect, not just the structuring, but what kind of taxes are involved. Where do you get the tax advice and all of that? What kind of administrative pain there is to actually support and administer these structures? That is all taken care of, plug and play on our platform. We operate the structures. We administer all of this. You know, Lemonway, the wallet provider, facilitates the money movement under EU regulation completely independently. It is integrated on the platform, but it's fully independent, fully compliant, and it's all built into this amazing system that helps us all engage in real estate. Your portfolio dashboard, property reports, and new deals are available at any point in time via the secure portal. And as I mentioned, you know, everything from compliance to money movement, and all of those administrative responsibilities are all taken care of by the platform. You simply go through the process of actually signing up to the platform. Gabby, if you might go to the next slide, please. You can sign up to the platform, you know, through a very, very easy process of getting verified on the platform. For those of you who have actually invested in the past using platforms such as, you know, Easy Equities, for instance, or any trading platform out there, you know that according to compliance, you need to get verified. You need to go through a verification process. In our business, we call it Know Your Client, KYC, or in the case of an entity that you would like to register on the platform, such as an offshore trust or a company, you know, you go through what we call the Know Your Business or KYB process in order to get you verified. So once you're through step one, you've signed up, you've got verified, all of that, immediately you're able to browse all of the investments that are available at that point in time on the platform, open for funding. You are also able to go to past deals to see what kind of deals do we generally offer, what kind of returns can you expect, what kind of exposures can you expect from us. If you go onto the platform, for instance, you will see that a lot of our deals have been very focused around the US market. As Gabby will also show you later, we're actually expanding into Europe in terms of our offering. So we're really expanding the offering so that each and every investor can find that which they are looking for. And at this point in time, it happens once you've signed up and you can browse. Once you've found the deal that really resonates with you, then you can fund your Lemonway wallet, which is integrated to the platform. So it's all in one place. You don't need to go to a different platform to operate the money movement. It's all integrated on the platform. You simply fund your wallet by doing your international transfer. the wallet at this point in time is it holds US dollars. So if you fund your wallet, if you fund it in dollars, great. If you fund it in a different currency, it doesn't necessarily work out very cheaply or quickly or efficiently. So please bear that in mind when you fund your wallet. It is a dollar-based transactional wallet. And basically, once you've gone through the investment cycle, of course, you can track your investments on the platform. You can give your wealth consultant a call or a WhatsApp or an email, any kind of general method of communication to track your investments, also to talk about new incoming deals or any educational stuff that we also run as a company, because we're actually a community-based company. We love engaging with our investors, and those are basically the channels that you can use to keep completely abreast of your investments, of what's in the pipeline, and everything in between. Basically, the first question, or one of the first questions that I always get from my investors is what are the costs involved? Of course, we've spoken about the the transactional wallet. We've spoken about all of this, but what does it actually mean in terms of cost from an investor point of view? So how we like to put this is that our fees actually match our mission. So basically what we mean by saying that is we don't charge asset under management fees as you would find at many other traditional financial institutions. We believe in only making money when our investors make money. So we are completely aligned. In terms of our business, one of our 3 core principles being trust, transparency, and alignment. Alignment plays into the way that we structure our fees so that we are aligned with our investors. We don't make money if you don't make money. It's as simple as that. We're aligned to give you the best quality deals that we can find. We're aligned to in an objective manner, give complete transparency as to the deal, as to the opportunity that it represents, but also as to the risks that are involved. We all know that anything, even money in the bank, has risks involved. And it is our role as a marketplace to make sure that this is completely transparent. In terms of the fees, what you can expect is an initiation fee of 3%. You can see the breakdown there on the slide of basically what it means. As I mentioned to you earlier, structuring, all of these types of costs that might be relevant to the traditional investor wanting to go out and do this themselves are basically taken care of by the initiation fees. So if you, for instance, were to invest $1,000, you would pay $1,030 upfront, that $30 being the 3%. And then the other costs that are involved are basically a 10% profit share fee. So this is where the alignment comes from. If you are generating if the deal generates a return of 10% a year, we take 10% of that return. That gives you a net return of 9%. I'm just keeping the numbers round so that we can all sort of see what the effects are. That's basically how our fees work and how we generate that alignment through the ways that our fees work. This, is also very, very well displayed on the marketplace. When you go onto the deals, you will see we've got a nifty new tool that we recently launched, and that is our returns calculator. So you will see that that basically you can see the returns, you can see the projected, distribution percentages per year of the deal, how fees affect that. So yeah, I don't want to hog too much time. I know Gabby wants to get into the practicalities.
Thank you, Fritz. Yes, so that's an overview of our marketplace, how you can become an investor with us, and what our general fee structure is. What I'd like to do this afternoon with all of you is actually dive into one of our current offerings on our marketplace today. It is the Opportunistic Senior Living Fund with the McFarlin Group. They are a newer sponsor with Wealth Migrate. McFarlin Group is based in Dallas, Texas. So we'll go over the background of them specifically, their management team, the senior living asset class, just as a niche asset to be investing in, and then specifically dive into this fund. What I wanted to show here is just generally the terms for the fund, and we'll speak to this again a little later in the presentation, but so that everyone can see here how this fund is presented on our marketplace. So this is a fund that's actually closing next Friday on the 16th of April. It is in senior housing. It is a senior housing asset class, or senior care or aged care asset class, with an established sponsor. And it is considered an opportunistic risk category. So high risk, high reward, though we'll talk more about the risks just now in this afternoon's presentation. For today, this minimum investment has been dropped to $97 US. So you can invest into this fund for as little as $97 with us to be a part of this, this particular fund. So who is the McFarlin Group? They are a vertically integrated senior living firm. Their goal is to generate superior returns by acquiring typically poorly positioned or over leveraged or undercapitalized senior living assets that provide an opportunity for acquisition at steep discounts, which creates steep discounts to cost, which creates wide margins of safety for fund investors. Overall, the McFarlin Group has 56 years of experience amongst their senior leadership team. They have $2 billion value of completed transactions by principals since 2001, with an average of 28% IRR net to investor realized on deals to date. So very established. They focus exclusively in senior living, and they both own and manage senior living assets. So that is something that we'll discuss as well. In addition to purchasing those properties, they also have a management arm that oversees the property management, building management of some of their assets. Again, just by the numbers, they have raised 103 million equity to date, with an estimated value of 550 million. And then 2.5 times investor realized cash multiple to date, 28% IRR.
Gabby,
so
if I might just interject there, what gets me excited about this, if you go back to that previous slide, is the standard of sponsor that we have, and the size and the track record. I mean, since inception, 28% return to me, and I think to most other people out there, if you can consistently return 28%, then you've got a very good investment strategy, in my opinion, and this is really exciting. Absolutely. For us and for the investor community, for sure.
Absolutely. And this is something that they've been able to do consistently for the past 2 decades, because they are quite an established sponsor. So to have that track record with that type of consistent return is quite impressive. And one of the main reasons that we are so proud and feel privileged to have them as a sponsor on our marketplace. But it's a great call out, Fritz. Thank you. So just to talk through a bit more about the objective of the Senior Care Fund, or the Senior Living Fund specifically. So the objective of this fund is to acquire distressed senior living properties throughout the United States, with an emphasis on the acquisition of non-performing loans from lenders and deeply discounted value-add assisted living and memory care properties. The fund will then add value over a 3 to 5 year period, aggregate those assets into a portfolio, and exit and close the fund at the end of that period. At the moment, they are raising investments or capital into this fund. They have started as of September of last year, September 2020, and that will continue likely to the end of 2021. We are currently raising, as a part of our first tranche with them that I mentioned, will be closed on our marketplace for our investors next Friday, the 16th of April. But it is likely that we will open a second tranche of funding potentially later on in the year. Really depends on how successful this current raise is. McFarlin uses fundamental real estate and real asset analysis and research, along with their proprietary market demand analysis, to really understand and underwrite their senior living properties. They employ a multidisciplinary approach that involves drawing from the multiple disciplines within their company and their experience to gain a fuller understanding of some of the complex situations that these non-performing senior living assets might exhibit. They do anticipate to hold these properties for a period of 4 to 5 years after acquisition. During that time, as mentioned, they are going to improve the property value by investing in capital improvements or deferred maintenance, by increasing occupancy, changing the operator of the asset to a local best-in-class operator under strict supervision by McFarlin. And many times that may also include changing on-site personnel and investing in training to ensure that the personnel within these sites are successful. They also initiate new marketing campaigns and provide new working capital to see the properties through specifically this COVID-19 pandemic and to a 90% stabilized occupancy rate. At that time, they do plan to aggregate these properties into portfolios, as mentioned, for an institutional exit that they believe will produce a 15% premium over selling those assets individually, which is part of why we have offered this through a fund as opposed to individual assets to invest in. Again, as mentioned, this fund has been open for investment since September 2020 and is available on our marketplace until next Friday to invest in through our communities, at which time it will close. They are going to hold each project, as mentioned, for 4 to 5 years and close and exit this fund within 7 years. Now, the interesting piece here is that by this time, in 7 years' time, the oldest baby boomer, which is the largest generation we've seen in our recent history, the oldest baby boomer will be 82 years old, at which time we expect the demand for senior living to be quite strong and the appetite for acquisitions to be favorable, with low cap rates and a strong price per unit. So they are targeting a net to investor IRR of about 20% or greater. So there is a lot of opportunity here, which is why this is listed as an opportunistic investment offering for our community. So just to talk a bit more about senior living or aged care as an asset class, specifically in the United States. Even before COVID, there was a bit of a construction boom, which created distress within the market. So even before COVID hit last year in 2020, they did see that there was a massive spike in construction of senior living, generally after 2012, upon exit from the Great Recession. Specifically in Sun Belt states, there was a majority of development. So those are kind of Arizona, Nevada, Texas, that Sun Belt region, where there is quite a heavy buildup of, or was quite a heavy buildup of senior care homes built or memory care homes built. What this then created was a bit of a bust because there wasn't as much of a large population able to satisfy the housing or the space, the occupancy that was available.
Maybe if I can
anticipated. Go for it.
If I can just speak to that a bit. What Matt Johnson told us, the managing director of McFarlin, is he said basically that this overproduction was caused by, specifically in the Sun Belt states, being sort of from the east to the west, the southern states, more red states, more Republican states, less sort of red tape to develop these kinds of assets, what Matt Johnson said was that a lot of these, or this construction boom was largely fueled by a lot of smaller institutions such as single multifamily offices, or what they call friends and family, building or actually investing in the aged care space, over the course of those years, due to the fact that the sector was so profitable. Obviously, the overproduction actually completely removed the margins there to be profitable. And what also happens now, as you mentioned, there was a pre-existing issue before COVID, which has been exacerbated by the pandemic. So what these institutions did, according to Matt, was these developments were highly leveraged as well. So that means that there's not a lot of margin for error in terms of costs going up or revenues going down. And obviously with COVID, what happened was in these facilities, they saw the lowest occupancy rates since they started to measure. I think it was around 2008 he mentioned. It might be 2006, but around there they started.
2005.
Oh, 2005.
The lowest occupancy rate since 2005. Yeah.
But anyway, so this is it's logical. What the way that Matt described it was that in that space, of course, these people are high risk for the pandemic. So the costs of operating these assets actually skyrocketed because you needed all of these protocols in place. You needed the what they call the personal protective equipment. They needed, so those were extra expenses. And on the other side, what happened was people actually started to take their elderly out of these, or actually the new supply of people who needed this service were more hesitant to actually enter into these facilities during COVID, which is completely understandable. I mean, I think a lot of us on this call probably had that same concern with our.
Oh, Fritz, I think I lost you. Okay, I think we lost Fritz there. Apologies, everyone. But to continue with what Fritz was saying, because of both this construction boom, this decline in occupancy, and then with COVID-19, senior assets is considered a distressed asset. Senior living, is considered a distressed asset in the United States at this time. COVID only expanded and deepened some of the pre-existing distress within senior living. But because of the experience of McFarlin, a majority of their properties did find success did ultimately see successful outcomes coming out of the COVID-19 pandemic, and all of their current properties do have a contingency built into their budgets, specifically to tackle COVID. So that is why another component of why this opportunity is considered opportunistic, because it is a higher risk. You are investing into a distressed asset, but the returns are much higher, in part because of that. And because you're with an established investor, an established sponsor, there is a more confidence that you can have in being able to battle or overcome some of the obstacles that COVID-19 presents. And we see that as well, right? Despite the distress in the demographic, tailwinds are favorable for senior living. As mentioned previously, the oldest baby boomer turned 75 years old on the 1st of January of this year. We see that a majority of individuals tend to go into assisted living or memory care or nursing care homes around the age of 82 to 85, which is just in about 7 years' time, around the time that this fund would be looking to exit. So there is high expectation that there will be an increased need in inventory and long-term demand for this particular asset. The McFarlin Group actually recently did an analysis that provided an estimate of the amount of inventory that would be needed between now and 2040 if today's penetration rates hold. And using population estimates from the United States Census Bureau for the next 20 plus years, they estimated that there will need to be approximately 880,000 additional units of inventory that will be needed to serve senior households over the age of 80 through the next 10 years. So due to those demographic patterns, the rate of change in demand kind of accelerates further out, with a need for roughly 54,000 units per year required between now and 2025, an additional 95,000 between 2025 and 2030, and an additional 105,000 between 2030 and 2040. So what this fund is doing quite cleverly is taking the opportunity now, while these are considered distressed assets, and investing their time and resources and expertise in them so that they can have a successful exit just in time for just as this asset class becomes more in demand. And this is also just so that everyone can see, on a 10-year basis, even through what would be considered a distressed period for the asset class, from 2007 to 2016, publicly traded healthcare real estate investment trusts, or REITs, for which senior housing and care properties represent quite a significant share of their investment portfolios. These REITs actually outperform the FTSE Equity REIT Index and the S&P 500 Index. So while it is considered a distressed asset, and even during this past decade, it still was performing quite favorably against similar indices. And this fund is already starting to work. So I just want to discuss or highlight here two recently seeded assets to the fund. The first is a memory care facility in Houston, Texas, that was purchased as a non-performing loan for a 42-unit memory care facility. At the time that it was purchased, there was quite a large gap in occupancy rates that had to be made up for. That occupancy as of June 30 was 76%, up from 67% when purchased. So you can see, even within a short 2-month period of McFarlin Group coming in, acquiring the asset, changing management, that occupancy rates increased during what would be considered the peak of the pandemic, specifically in Houston, Texas, in June of last year. And they were able to increase that occupancy rate, secure more stability within the asset, and upskill their team there. And then an additional property that was recently sold in November of last year in Westbrook, Maine, was a medical office that is just adjacent to a senior care facility. So this fund is focusing not just explicitly on memory care or senior care facilities, but as well as medical offices that are near and support senior care, memory care, nursing care facilities. And this medical office was purchased in, as I said, sold at November 2020, purchased at 14% of par. And our investors saw at what I believe it was what says right here, 1.57 times cash multiple and a quite phenomenal 505% IRR rate. So these are the types of assets that this fund that you are investing into will be targeting, acquiring, and improving. So I'll stop here, or I'll pause here rather, and just see if there are any questions specifically related to this this asset. And I see we have some questions about if the sponsor will also manage the property. And just again, yes, they often will either manage the property directly. They do have a property management company called Surpass Living. And Surpass Living does manage many of their local properties, or I should say properties that are local to Texas and the Sun Belt region. However, in areas or regions where it's a bit further out from Texas, they will look to find world-class kind of local operators, individuals that understand the area well. And I think that's important here to emphasize as well, is that McFarlin recognizes that if they're located in Texas, which is in the southern United States, but they're interested in purchasing a distressed asset in Maine, which is far, far north in New England, and in the northern United States, that they need to understand that they have to have a local operator, someone who understands that market, the needs and care of individuals from that state. But they do quite a heavy vetting process to ensure that they are putting a reputable and capable operator to oversee that asset in that region.
Yeah. If I can just add something there, Gabby, Matt mentioned to us that supports living is a highly successful a segment of the business in its own right. It's very profitable. As you mentioned, obviously they have their headquarters in Dallas, and in the southern states they specialize in Surpass Living operates those assets that they have there. They are targeting, as we said, they are targeting specifically the Sunbelt states for what we already mentioned. But Matt said that if there are opportunity elsewhere in the country, they would not necessarily not engage in those opportunities. And, they've done it before where they partner with a local, I believe it's in the northeast of the US, north of New York. They've got a facility there that's run by a partner a property management company. And it's almost like what our model was always, and what Scott always hammers on is you partner with experts that are there and that are local, as you said. And through operating Surpass Living, Matt also mentioned, because they are also a management company, they know what to look for when they actually partner with companies to manage their assets outside of their own sort of regions.
Absolutely. Thank you for that, Fritz. We do have a question here from one of our attendees asking just to explain the difference between cash on cash and IRR and correlation. Fritz, is that something that you would like to tackle? Yeah,
by all means. So in terms of the correlation, I don't really understand. Andile, if you would like to just sort of expand on that side of things. But the IRR is an abbreviation for internal rate of return. It's very closely related to return on investments that we all know. It's very basic return over principal during a year. That is return on investment. But IRR takes into account the timing of cash flows as well. So it's a bit more of a ambiguous sort of metric. But basically, what it comes down to is the aggregate return that you earn from an investment during an annum period, during a year, basically. Now, the important thing to note here from a Wealth Migrate investor user perspective is that the IRR consists of the cash on cash metric plus the capital appreciation component that stems from the deal. So cash on cash plus capital appreciation equals IRR. So if you look at McFarlin, for instance, 16.7, which is your total IRR, minus 3.42, which is your cash on cash, would equal the capital appreciation component. Now, that does not actually realize during the life. That the capital appreciation component, of course, does not realize during the life of the deal. Accrues on a linear basis per year of the deal. And then at the end of the deal, you realize that capital return as a capital appreciation. The cash on cash, however, is deemed as a yearly, it's almost like a passive income, like we call it distribution. We used to call it dividend, but distribution is more broad, as you will find, through discussions with the returns classifications of each deal is. But a distribution basically is your quarterly payment that you will get into your wallet, directly into your wallet. And that 3.42% there is the annum return. So you'll see in the case of McFarlin, it's more geared towards a capital appreciation due to the nature of the deal. As we spoke about the entry and the exit and the time frames involved, logically, you can understand that the returns are realized to a large extent towards the end of the deal. Some deals, for instance, are fully cash on cash and they are cash generating. So that's very important for an investor to understand in terms of what fits with what they're looking for. Am I looking for something that generates a return for me? Or am I looking for something that's more of a capital appreciation type of situation? I hope that answers your question, Andile.
Yeah, thank you, Fritz. Very beautifully explained. So this is the offering that we have lowered the minimum investment amount for today. However, we do actually have another offering on our marketplace at this point in time. It does not qualify for the WealthE Wednesday lowered investment, but I would like to just quickly discuss it with this group because you are likely to see it on our marketplace and you may have questions about it. This is a new offering with another new sponsor, Reward Properties, and New World and RE Capital. So Marvila 2 is a residential development located in Marvila, Portugal. It's about 15 minutes drive away from Lisbon, the capital of Portugal, from Lisbon city center. This is a new development, so they're actually breaking ground on this property in the next few months. And it is being offered through the developer Reward Properties. Reward Properties is a new joint venture created with RE Capital. They are based out of Geneva, and New World Properties. For those a bit unfamiliar, New World Properties is owned and founded by John Robbie, a fairly renowned South African developer and real estate developer. He is known for his developments in Cape Town, specifically, if you're familiar with the kind of regeneration or reinvention of the Cape Town waterfront, of Woodstock Exchange and their properties, or of Century City. John Robbie and his team are all behind those in South Africa in particular. But Reward and New World specifically are focused now on developments in Portugal. And we're very pleased to be able to offer this particular offering to our community. It is the first offering that we can provide to our investors that is located in Europe, in quite an exciting, I would say, country and city in Portugal. Very vibrant with a very, I would say, fairly large and growing middle class. The property itself is a residential development, and the offering here is a hybrid of both capital growth and returns generating investment opportunity. So as an investor, by investing into this property, half of your investment would be going into half of your investment would be going into capital growth, and then the other half would be into revenue generation. There's more details on this on our site, so please take a look, reach out to myself, Fritz, or Alex if you have additional questions here or want to jump on a Zoom call to go through the brochure. We always try to make ourselves available to our investment community. You will note that for this particular offering with Marvila, it is a $10,000 minimum investment. That is it for us today. I just want to say thank you so much to everyone who was able to join us. Fritz and I will just leave our Q&A box open for the next minute or so. If there are any additional questions, please feel free to type those either in our chat box or in the Q&A box.
Thank you everyone for your time.
Sorry, I just see a question here from Tina. Yeah, absolutely. I see a question here from Tina Johnson. Jonathan. So, the latest that you can invest in the McFarlin Senior Care offering is until next Friday, April 16th. But if you want to invest lower than $5,000, you must do so today by midnight today. That's midnight South African time. However, the offering will be available, as I said, for a minimum investment of $5,000 until next Friday. And yes, Justin Jacobs asked a question on cash, and cash is paid out quarterly to your wallet. so you can receive you do receive rather your returns there. Wonderful. Okay, great. I see Mafeno has a question about taking payments in Bitcoin. Unfortunately, we do not have a Bitcoin option yet, but trust me, it is something that we are cooking up on the back burner. Something exciting to be released maybe in the next quarter or two for our interested investors. And yes, thank you everyone. Fritz?
You would also note just before we go that I just added the link to the launch webinar of Marvila, the Portuguese deal that we spoke about at the end. If you want some more information, feel free to watch that.
All right, and with that, thank you so much for your time this afternoon. We had a great time speaking with all of you. Chat and get in touch with us today if you have any further questions. Take care, everyone.
Thank you, everyone. Bye.